Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's conversation. I'm absolutely thrilled to have with us David Namdar, who is the CEO of the BNB Network Company, also one of the original co-founders of Galaxy Digital, and a very, very early crypto entrepreneur and investor. David, welcome to the conversation.
Thanks, Lex. Happy to be here.
So give us a whirlwind tour of how you got into crypto and then what led you to be a co-founder in Galaxy. What was that like in the early days?
Actually, that wasn't my earliest chapter in the space. I guess the real starting point was I started my career out in Hong Kong at UBS. I was covering all the Asian markets and then really trading on a global basis. I came back to New York, was working at Millennium, one of the biggest hedge funds, and again, trading in almost every stock market in the world. And I realized that people in Asia kind of had an advantage to people in the West when it came to thinking about currency, because the average person in Hong Kong and Tokyo and Shanghai thought about multiple currencies on a daily basis, much more so than people in the West, where you've got the dollar and the euro and everything just works. And so when I was at Millennium, I first was exposed to Bitcoin, and I started going to some of the earliest Bitcoin meetups in New York in 2012, 2013, and tried to convince other people in the hedge fund world and banking world to open their eyes to it. And when I saw the resistance there, I left end of 2013, early 2014 to start my first company in the space. And that was SolidX Partners. And the idea was to form a niche investment bank focused on digital assets. We tried to do a Bitcoin ETF, second in the world after the Winklevoss twins. And we tried to create the derivative side using total return swaps and put out one of the very first research reports ever on Bitcoin and digital assets as an institutional asset class. So that was all 2014, 2015, a bit too early, but especially following what happened with the collapse of Mt. Gox in 2013, when a lot of people were still kind of worried about the risks too much and all the things, and people thought that governments were going to shut it down and Bitcoin would never become what it is today. And then a couple of years later, I got connected to Mike Novogratz. He was out of Fortress at the time and just focused on managing his family office. He'd made a couple of investments in the space, in Ethereum, in Ripple, and through Dan Moorhead at Pantera that he knew from Fortress. And I went in to manage all of his digital assets and do what I do best at this point of just create chaos and expand the opportunity and suck everyone into crypto more and more. So I fought with everyone in the family office and pulled him and them deeper and deeper into crypto and planted the seeds to launch a hedge fund and a business together. That became known as Galaxy Digital. Then I brought the opportunity for us to go public, and we couldn't do it in the US markets at the time because of the regulatory environment. So we saw the opportunity to do it in Canada. There'd been a couple of crypto mining companies that had gone public in Canada, and it was just a bit more open to it. Some people in the Canadian market even thought of, they just made a comparison of real mining, gold, silver, other commodities, and crypto mining. And so, they were a little bit earlier to embrace it. And we were the first ones to really bring a kind of real diversified crypto investment bank and crypto business to the public markets. And it was the kind of larger version of my first company, SolidX.
That's an incredible amount of activity compressed into a very short amount of time. So thank you for that. I'm really curious actually on the public markets because it's going to reflect a little bit the conversation about digital asset treasuries. What was the motivation to go public? I mean, there's often just like, let's get liquidity for owners. But, for a business like Galaxy, how are you thinking about at that time the need to go public on the Canadian exchange? And then how are you thinking about sort of the market structure of that exchange? Like it wasn't the NASDAQ yet. So was there enough liquidity? Did that matter? Like what were the considerations?
Sure. Yeah, actually, that's a great question. And so I'll take it back to SolidX for a sec. So one of the issues with SolidX was after the financial crisis, the things we were trying to do, create a Bitcoin ETF, right? In order to have a product that retail investors could trade, that institutional investors could, manage creations and redemptions in their ETF desks. The problem was it was too early and people didn't see the opportunity and were too worried about the risks of Bitcoin as the underlying asset. For the total return swaps that we were trying to do, the issue there was these were ISDA, which is a like standard form, of international kind of derivatives contract. And the banks didn't want to face a small new company or startup on these kind of ISDA agreements. And so had SolidX actually been a public company earlier, right? Because if the environment or opportunity allowed for it, both of those would have been things that, SolidX may have succeeded at bringing to market. So with Galaxy Digital, when we thought about what that business looked like across trading, investment banking, advisory, and thought about all the different parts of the business that, we could build out, we saw the need to have the credibility of being in the public markets and also to be able to tap into that public markets capital to grow out the business. Now, almost 10 years later, we're seeing a lot more companies be able to access very large amounts of capital in the private markets. But at the time, even back then, both the validation in order to attract customers and do business with other large organizations and the ability to attract capital through public markets were really the driving factors.
Take us through a little bit the next couple of years as it was focused on the public markets in the US. And I think the lens that I want to explore is the sort of wobbly transition from fintech to digital assets to crypto to DeFi that's going on in terms of what people are comfortable with owning, doing, and from a generational perspective. And also kind of the temperature of the US public markets for these assets. And it's a loaded question. In my mind, I'm thinking about the SPAC boom of like 21, 22, the fintech companies and IPOs coming to market, and kind of that early phase of crypto exchanges and brokers trying to come to market as well. Can you trace the evolution of how US capital markets have looked at our asset class and these kind of adjacent plays?
Yeah, absolutely. And actually, I think this is kind of what I love thinking back through. And, I remember when we first met around that time, kind of something between 2016 and 18, and, seeing the evolution of the market since then. So one of the key things that unfortunately had hindered a lot of this was kind of the onerous regulatory environment. And so I still, and a lot of others in the space, look at the regulation of the BIT license in New York by the NYDFS and Ben Lawsky. And that really slowed down and pushed away a lot of innovation and crypto companies and capital from coming to New York and from, coming to the US. And I think that had weighed on the markets through 17, 18, 19, and, you could say even potentially all the way till today. So now in 17 and 18, during this kind of ICO boom, and as a couple of companies like Galaxy and some of the miners got public, I looked at it then like Bitcoin and Ether became the funding currencies for the digital asset world, that people had to buy Bitcoin or buy Ethereum in order to participate in all of these ICOs and all the other things that were kind of burgeoning across the crypto ecosystem. And what happened was companies were holding on to, if you raised a bunch of Bitcoin in an ICO, then they were holding on to that Bitcoin and they saw the Bitcoin went up in price. So, and similar for Ethereum. So the ICOs and the companies that were receiving the investment ended up becoming kind of speculators on the underlying asset. And as more and more people had to buy Bitcoin and Ether to get into these projects, and they saw that these projects made money on paper or on their balance sheets, it created this kind of reflexive or leveraging process as the markets had levered up. A lot of that was taking place outside of the public markets, and there was very little of that happening in public markets. Then in kind of 2021, during like the DeFi boom or decentralized finance boom, what was happening then was, instead of just being able to access the crypto world through Bitcoin and Ethereum, there were a number of different rails that were set up where people could actually invest through stable coins. Tether had really started to grow in size quite a bit. Circle had started to become popular as well, and then a number of the other large crypto assets. So people could come into the crypto world through those mechanisms. And what was happening was same thing. Another leveraging process was created because new projects were incentivizing people to lock up their tokens or lock up, whether it was Bitcoin, Ethereum, or stablecoin, to lock up their tokens or their value into these new protocols through yields that were being given. And one of the lines I'd come up with then was really a lot of it was inflation disguised as yield. If you and I start a project and we own 50% of the supply, and then we sell the next 10% of supply to people, but we hold back 40%, right, that people can earn into. Well, as they're earning into that extra 40% remaining, me and you or whoever was the earliest people that started that project are then selling into the new buyers as they're kind of waiting to collect those yields.
Let me pause you on this just because it was always amazing to me, like economics 101 that you maybe learn in high school is the difference between nominal interest rates and real interest rates. And I feel like so much of crypto would just not exist if people understood the difference between nominal yield and real yield.
No, I think that's where one of the other things I love about the crypto market is whatever people were doing before, once they get into crypto, the hope is that they have to, or they are able to kind of grow and evolve. So if somebody came from a hedge fund background, right, or markets background, well, all of a sudden they need to learn about and understand early stage technology investing and understand regulatory environments across the world and understand technology in a way they never had before. If someone's a lawyer, they need to understand markets, late stage investing, early stage, what's the security and technology more than they ever had before, and keep going down that path. And so I think that that's a positive, but at the same time, to your point, there's also been, and in every cycle, there's a lot of misunderstanding of economics and, what's real technological innovation and what's hype and what's, just marketing.
That gets us to the public markets being receptive to some of the crypto companies and fintech companies after COVID. And you've got, this lockdown of 2 years where everybody's online. Hyper speculation turned on, everything went digital, all commerce went, to Amazon instead of to terrestrial stores. And so people were ready for these, you had like the GameStop, Reddit army show up. So you had this kind of capital again waiting to deploy, but then it all disappeared. What happened then? That's where particularly there was an overlap in some of this hype and excitement between GameStop, Reddit, and then, I think back to Coinbase IPO, and was pretty similar to like kind of the hype and momentum of Robinhood, and it all kind of converged. And I think what happened, or one of the beautiful things about that chapter was, outside of crypto, that was really one of the first real attempts of retail kind of taking ownership or kind of getting more empowered over investing in capital markets. And, a similar process was playing out in the crypto markets as well, and part of this longer term and bigger vision of really taking out middlemen and having more control over your finance and sovereignty over your money. All these big, vision themes and, idealistic future states of what money and finance can look like. But then, they kind of got hit still with a wall of TradFi regulations and kind of market structure that, I think some people would say that like the game was still rigged, right? So if I remember correctly, like there were a number of times where, Robinhood, because of some of the funds and institutions behind it, turned off buying of some of the theme and fad stocks and meme stocks. And so, I think if anything, even though that caused kind of a temporary collapse in the markets then, it also led to more and more belief and kind of confidence in the crypto markets where, those conditions don't exist, where you don't have these large institutions that can kind of rig the game against you. Take us towards digital asset treasuries. Let's define what they are, kind of how they came about, and then we'll go into what the market looks like for them. For that, we also have to just go back a little. So I think I always like to give credit to the people who've kind of started this off. And I usually start with Michael Saylor, but I'll go a little bit earlier. There are actually one or two companies, and have reconnected with some of them today. Like Charles Allen is a friend of mine, if you ever came across him, who's running BTCS, which now is kind of pivoted. It's looked at as an Ethereum treasury. So that's really
he was public as early as 2014 or 15. It was one of the first companies to hold assets on the balance sheet of a public company. These other mining companies, they were tending to, they would mine Bitcoin or Ethereum, but then they would sell the assets to pay their fees and kind of treat the rest as revenue. So then, if we go back 5 years ago to Michael Saylor had been running a company for most of his career, right? Tech 1.0. And the business was a software business that had kind of failed or struggled to grow, but it had about 400 million of cash on the balance sheet. So he ended up being convinced about the merits of Bitcoin and the upside, in the crypto world, in a very funny story, because the story that I've heard is that he sold the domain voice.com to Brendan Bloomer, who had done the Block One EOS ICO. And after he saw that he sold it for 30 million, he realized, whoa, there must be something here if these crypto guys have this much money. And so that opened his eyes to the opportunity, or reopened it. And from then on, he was kind of all in on Bitcoin, and has done it in, a kind of unbelievable way. So he took the 400 million of cash he had on his balance sheet, made the decision to put it all into Bitcoin, and realizing that, Bitcoin is a much stronger, more sound money than fiat currency. And he fought with the board, he fought with, whatever other rules he had to get through. Ultimately, after he started to purchase the Bitcoin, his stock traded at a premium and people were excited about it. So the market rewarded him for that. And then what he's done over time is he sold more equity when the stock traded at a premium to the Bitcoin holdings, and he bought more Bitcoin. And he sold equity and he bought more Bitcoin. And he kind of went through this process of kind of the financialization of Bitcoin, of then issuing convertible debt and issuing other financial products solely with the intention of accumulating more Bitcoin. So now over the last 5 years, he's been able to accumulate over $75 billion worth of Bitcoin, and the stock and companies trading and valued over 100 billion today. So because of the success and what he's accomplished and accumulating over 3% of the Bitcoin supply, that's led to a number of copycats and kind of the proliferation of that strategy. He's partly responsible because he's been actually out there running an event, Bitcoin for Corporates, and teaching people, treasurers, CFOs, small business owners. He's been teaching people at large public companies and at private companies about the merits of holding Bitcoin over fiat currency. And, now in the last couple, year or two, we've seen this proliferate in the US, but also in a number of markets around the world. So now I think there's over 100 digital asset treasury companies focused on accumulating Bitcoin. There's a dozen or so, that we're now seeing look at and realize, wait, there's actually the merits to holding some of these other important crypto assets. So there's, a handful that are focused on accumulating Ethereum, a handful that are focused on Solana, and starting to see some focused on BNB, as well as a couple of others.
When you look at what Saylor's done, and especially kind of the early premium of the market capitalization to the net asset value of what was on his balance sheet, what were the financial instruments that he was using that allowed for, such rapid growth to occur?
Sure. So, early on, I don't know the exact time when he started to use convertible debt, but I know that in this 21, 22 period, his business had faced some fragility. I think he even was borrowing some money on chain using some DeFi products, if I remember correctly, because I remember people were focused on a liquidation price that he could have achieved had Bitcoin fallen to 3,000 or 5,000 then. So he was utilizing kind of ATMs, which are at the money, to sell his equity when it was trading at a premium. And the premium has kind of persisted for a lot longer than people have believed. And usually I think it's average between 70 to 100% premium to the Bitcoin that he's been holding on the balance sheet along the way. And then he also was the first, when I said the kind of the financialization of Bitcoin, he had utilized a number of convertible debt offerings. And as his balance sheet grew, he was able to get surprisingly very strong terms on that debt. I think he issued some preferred shares as well, preferred equity. And so what he's been doing, and part of kind of what he sold is, well, Bitcoin is growing at 20 to 30% annually, or even faster. It's one of the fastest horses, in the entire world. I think he's described it as. And he looks at it as, well, any chance he can to borrow money today in fiat terms and pay it back at 0%, 5% convertible debt, right, it's worthwhile for him to do that and to own as much Bitcoin as he possibly can. And so that strategy has worked out very well for him. I think what's interesting now, when we look at the landscape of digital asset treasury companies, a couple of them have also explored using convertible debt. A lot are moving away from that and trying to move away from kind of anything that puts the balance sheet at risk. And one of the reasons why I say that is because a lot of the convertible debt holders and investors today, they're at much more aggressive terms than what Michael Saylor has been able to get for strategy. And the convert investors, they don't really care what the underlying asset is, whether it's Bitcoin or Ethereum or anything else. They just care that they have a claim on it. And they're actually incentivized to short sell the stocks and, just to hedge out their exposure. And so I think moving forward, we'll probably see these treasury companies use less convertible debt and come up with other mechanisms that are much more aligned with, keeping all investors on the same page going forward.
Why do you think the premium in MNAV persisted for so long for MicroStrategy?
That's a good question. I think he has been out there telling the story well, and it's an aspect of belief in his ability to accumulate more and grow the Bitcoin per share for his underlying investors. And so I think that's a key thing when I look at, I've been approaching the treasury space myself as an investor. I'd invested in MicroStrategy on and off over the years. I'd invested in MetaPlanet and, now been investing in a number of the more recent ones this year and this cycle. And when I think about, my own approach to investing, I try to think about, all right, who are the management teams that I'm betting on? They're going to be able to grow the Bitcoin per share, the Ethereum per share, the BNB per share, right? And people that I think are going to be in this industry 3 years, 5 years, 10 years from now that aren't just coming in to capitalize on kind of the exuberance in the market, in any short period.
Can you talk about the dynamics in DAT pricing over the last, call it 6 to 12 months? And I know that we're soon going to get to Binance and BNB and the DAT that you're leading, but I'd love to just get that kind of last bit of context of what's happened, between, let's say, May and October of this year.
I think what really kicked off a lot of this DAT proliferation this year, where I look at really two things: MetaPlanet in Japan and Nakamoto here, who are the founders in Puerto Rico, David Bailey. And so with MetaPlanet, it was the most successful, or it is kind of, in one sense, the most successful Bitcoin treasury company around the world after MicroStrategy. And what they were able to tap into was to realize that, well, the Japanese market's a very interesting market where there's beneficial tax rulings around owning and having Bitcoin exposure through a public company versus through individual kind of holdings of it. And so they managed to, then they were trading at a similar premium to MicroStrategy for a period of time, somewhere between 50 and 100%. I think they had about a couple hundred to 700 million worth of Bitcoin on their balance sheet. And then all of a sudden, when people realize this opportunity that it's a faster way to get capital from the Japanese market into crypto through the public markets, the premium expanded, and all of a sudden MetaPlanet was able to vastly increase their Bitcoin holdings and I think the premium got up to 400 or 500%, and they issued equity up there and were able to really start to grow their Bitcoin per share. And they've accumulated, over a couple $1 billion worth of Bitcoin at this point. And then here in the US, Nakamoto was started by David Bailey, who was one of the earliest people I've known in the space and really been a Bitcoiner kind of from the very beginning, even longer than Michael Saylor, longer than almost anybody who's active in the space today. He was the founder of Bitcoin Magazine and BTC Inc. And when he shared, and he actually was one of the lead investors in MetaPlanet. So he'd been following the MicroStrategy playbook and seeding some of these Bitcoin treasury companies around the world. And then in forming his own, Nakamoto, it really opened people's eyes to the opportunity. And what he did was he was very successful in raising awareness and raising capital. I think initially he was going to go out and raise 200 million of capital and ended up raising over 700 million. And so that really kicked off this wave of other Bitcoin treasury companies where, we've seen Anthony Pompliano and Vivek Ramaswamy with Strive Asset Management, and we've seen a lot of these others take different approaches, some through kind of mergers with existing businesses, some through SPAC mechanisms. We saw Jack Mahlers from, with Cantor and Tether do one 21. And so really seeing a number of different approaches to the market. Then, I think everybody was focused on the idea that you're investing in a pipe or you're investing into this company, at a NAV of close to 1. And if the premiums persist, you have a chance in a short period of time to get, some small or meaningful return on your capital as the public markets assign a premium to these treasury companies and then get the flywheel going. So that was the initial idea and kind of what people got excited about going into it. Then we saw two main Ethereum ones come to market, or the two largest ones today, SharpLink and BitMine. And BitMine had been an existing company operating in the space. SharpLink had been a gambling company, but that was taken over by Joe Lubin, one of the founders of Consensus and founders of Ethereum. And so as they kicked off, they really were able to kind of sell people on this vision of, well, Ethereum's an incredible asset. There's a lot of hype and momentum in the stablecoin theme on Wall Street following the success of Circle's IPO. And they managed to capitalize in a short period of time. And by selling equity at a premium, also selling into, and the hype, as I'd said about Circle, they accumulated, I think, over 15, 20 billion worth of Ethereum in a very short period of time in a accretive way where they were able to grow the value for those initial pipe investors and the initial shareholders. Now, in the last couple of months, I look at it where it's been a little bit like the ICO boom, where, 2017, 18, where I kind of developed this thesis that, if you look at X amount of capital, let's say out of the next 50 to 100 billion of capital, something like 25 to 50% of that is going to go to the largest 5 or 10 companies, right? MicroStrategy, MetaPlanet, it could be 21, ProCap, Nakamoto, any of these, and then, SharpLink, BMNR, and some of the others. And the next 25% of capital is going to go to the next, let's say, 20 or 30 of those companies. And then the last 25% of the capital might go to this long tail of 100 to 300 companies. And that's kind of exactly the distribution of how it played out with ICOs. There were, from the longer tail, there were a couple of companies and projects that surprised. And you were like, wait, how did this one raise 30 million? How did this one raise 100 million? And some of those exist today and ended up, becoming meaningful projects, and some didn't. And so I think that the way that the capital's kind of been dispersed among these different buckets, that's also now led to a lot of kind of investor confusion, and also just a period, as tends to happen in crypto, where there's a lot of hype and excitement to then, a lot of kind of hesitation or worry and exhaustion. And I think the market's just feeling a bit of exhaustion right now towards the Treasury strategy. And that's why, a lot of them are trading at, premiums to their NAV today even.
There's been a lot of different types of tokens and coins that have gone through like the digital asset treasury approach. And in many cases, the DATs are replacing what the foundations used to do. And now that we have a more crypto-friendly set of regulators and politicians, you can create commercial entities that want to grow protocols. You don't have to wrap them in these non-commercial foundations and grants and kind of like cultural misfits almost to what the actual goal is. So that was a lot of context, but I think it was extremely helpful. Tell us a bit more about Binance, about BNB, and what you're focused on.
Sure. No, and like I think it's important because the context matters, and it's what I think always when people get into the crypto space, or when they see during these periods of excitement, or in the most recent phase as we're living through it and building it, the people who have that context are able to see and understand kind of where we are and, what's led to now. And so you just mentioned like this regulatory environment that we're in today, that's, I think, the most important piece that's kicked a lot of this off. Had the regulatory environment been better earlier on, we might have gotten a Bitcoin ETF, or the Winklevoss twins might have gotten their Bitcoin ETF. We might have seen investors in the US make $50 to $200 billion of gains on Bitcoin already, and it would there'd be a lot more innovation, a lot more companies, and a lot more activity happening in the US. Well, at least it happened in the past year, and so now That's what allowed for some of these newer crypto companies to come to market between Circle, Gemini, Bullish, and I think there's a wave of other crypto companies that we're going to see get public. And we also will see, more that sensible regulation that actually invites and introduces more, opportunity and growth for the crypto exchanges that exist in the US and some of the ones that are operating internationally to interact with and allow US customers in a way they hadn't before. I think the CME or someone had put out regulation, or CFTC had put out regulation recently or an announcement that they're exploring allowing US investors to access offshore international crypto exchanges. So that'll be a significant point as well, and could be, one of the biggest stories of the next, 1 to 2 quarters. Now, for me, the regulatory piece has been something I've followed closely. So after Galaxy, I had the opportunity to be the CEO of FTX US or Binance US or a number of public mining companies, and none of them felt like the right thing. I didn't want to be part of just one exchange or one company and kind of put all my energy behind it. And also because the regulatory environment would have been, I think might have pushed me out of the industry if I had to deal with all the headaches, that came with doing it. Because I know somebody who was running one of the exchanges at the time, and I think they burnt out completely, are no longer in the industry. And so then when I think back to the last couple of years, I've really been investing broadly across the space, supportive of a number of kind of early participants that have been looking to kind of sell out of their businesses or take them public, whether through IPOs or SPACs. And through that process, just kind of felt like the Binance and the BNB story have followed me quite a bit. And so I had been like, after investing in some of these, a couple of close contacts had been telling me, all right, well, look, you've been doing crypto and capital markets for longer than a lot of people and kind of better at selling and explaining the Treasury story and model more than a lot of the management teams and more than the bankers for sure. And so they really wanted to push me to run one of the Bitcoin treasuries in any market in the world. And as I started to look at it, just from a very genuine standpoint, I didn't think, and I still don't think I could as passionately and with as much conviction share the Bitcoin story as well as Michael Saylor or David Bailey or Simon at MetaPlanet or a couple of these others. But when I think about what I've done in the space and everything, I like pointing out and identifying things that are happening around the world and the true global nature of the crypto markets, and also helping people see overlooked and undervalued opportunities. And so, the idea of running a Bitcoin treasury company didn't resonate as much and felt like it would actually be harder for me to do in a very genuine way. But the idea of running a BNB-focused treasury company just felt like it fit just right. Ultimately, I was convinced to do it by a couple of close partners of mine. And, I'm super grateful because it's been an incredible story to tell already the last couple months. And, I think in the coming years ahead, it's going to be something I'm very, very passionate about and excited to share and work on.
Let's lay the groundwork. What is Binance? How big is it? How many users does it have? Can you give us some scale relative to companies we might know in Coinbase and so on? And then what is the BNB token?
Binance is by far the largest cryptocurrency exchange in the world. And so just to put this in scale, I think they publish on their website the total amount of users. I think it's just pushing past 290 million users. From a scale standpoint, I believe Coinbase is somewhere in the 20 to 40 million user range. Kraken is between 10 and 20 million users. Gemini, I think, also is in that 10 to 20 million user range. So as an exchange, we're talking it's something that's potentially between 5 to 15 times larger than Coinbase or any other US exchange. And it also is by far, as the largest trading volumes across almost every single trading pair. And I think they're making up almost close to 40% of all global crypto trading volume. So to put that in some perspective, if we were to think about any other vertical, if you look at Facebook and Google and Apple, in each of those verticals, the largest company in that segment is a US company that's publicly listed in the US and has a ton of US customers. Binance, as the largest cryptocurrency exchange in the world, is not active in the US, and they don't have any US customers. And so, had they if they were able to access US customers, and US customers obviously would want to access the significant liquidity and opportunities they have there, then it would be like significantly bigger as well. And so I can't think of another market in the world or another vertical where the largest company exists outside the US. US investors have no opportunity to invest into the equity of that business, and US users can't even access it as customers as well.
How does the token get you there? How does the token accrue value? And then how does the DAT accrue the value from the token?
When Binance was first kind of picking up steam in 2017, 2018, they had introduced and were one of the first to introduce kind of an exchange token. And this was different than Ethereum and Bitcoin, where the token's initial utility was to provide discounts on trading fees on the Binance exchange. And so, some people point out, and I've heard, which is a fairly accurate statement, that in a lot of ways, trading is the biggest and kind of most successful use case within the crypto world so far. And by trading, for some people, that's speculation. For others, it's exchange of value, and for others, it's kind of growth and investment. Right? We've had an asset class that's grown from hundreds of billions to 4 trillion today. So there's been a number of different areas where the importance of trading in and out of value is arguably, the case could be made that it's really one of the most important areas of crypto. So when they first introduced the token, it would provide fee discounts on all of the trading fees on Binance, and then they upgraded it, migrated the token to then grow from kind of its initial uses to then, for the last 5 years, it's been known as a BNB chain. And really, it's matured into being this whole vibrant ecosystem now that's still powered by or has a relationship with Binance. There's still, out of those 290 million users I mentioned, I believe I've seen some estimates that 80 to 90% of those users utilize and use BNB to pay for those reduced trading fees. So in a lot of ways, you can make the case that BNB is actually the most widely used or regularly used cryptocurrency in the world, except a lot of that's an off-chain activity that's happening on Binance. But that still benefits BNB over time. And so BNB also allows people to participate in other areas of the ecosystem, to earn airdrops, to kind of earn discounts and other things. And so there's really this constant organic demand that happens for the token, which makes it's a bit different than what exists with Bitcoin and Ethereum as well. With Bitcoin and Ethereum, Ethereum has a kind of gas or burn that happens from every transaction, but that gas is going to the miners. In the BNB ecosystem, there's a kind of burn that happens in every single transaction. Every single transaction creates a tiny deflationary mechanism that reduces the total supply. Every transaction, all those trading fees that are mentioned, actually go towards a quarterly burn that reduces the total supply of BNB. And so, to give you some perspective, the last 4 quarterly burns averaged over $1 billion per quarter of BNB that was burned. I'm expecting this quarter to be the largest one ever by a significant margin. I believe it's going to be over 1.5 billion. It might get to 2 billion of value of BNB that gets burnt, and that leads to a reduction in the supply. So just to explain a little bit, one of the ways I look at that, while these are not equities, right, and it's very important to nuance to realize that crypto tokens aren't, it still has some similarities to a mechanism. If you look at a stock buyback, if you look at what Warren Buffett does at Berkshire Hathaway or any large company, when the company makes money, they have the choice to pay it out as a dividend, or to reinvest it in the company, or to buy back their shares and reduce the supply. With BNB, there's kind of a native mechanism that's been reducing the supply by anywhere from, call it, 3 to 6% per year.
Does it matter if the DAT trades below MNAV or not, first of all? And, if it does, what are the tools you're going to have to manage that?
So let me step back a sec just to kind of introduce a little bit of why and how we started this and where I see it. So when I think about the DATs and the opportunity, right? As I said, I've been investing in them. I'm investing in them for the medium and long term. MetaPlanet was the best performing stock, I think, in Japan, and one of the most liquid stocks in Japan last year. But it took there was some groundwork that went into it, and it took a year or two for the story to play out. And that still happened in a short period of time. MicroStrategy, it took 5 years for people to kind of, realize just the massive accumulation effect that they've been able to achieve in growing the Bitcoin per share. So when I think about this and approaching it, right, I'm looking at it like, well, BNB is this incredible asset that I want to own more of, right? And I want to help people own and get exposure to it. There's an aspect, like I mentioned, where it's not easily accessible in the US, right? So not only the lack of having US users has kind of prevented and could be an upside catalyst that could drive value in the future, but also, it's very hard for them to get exposure even in buying the underlying asset. And so part of this is trying to think of and create a way to have an access vehicle, right, in a regulated NASDAQ publicly listed company for people to get exposure, and something that when I think back to when I first, was working on a Bitcoin ETF, right, it still pains me a little bit today that by not getting an ETF approved back then, the SEC and others that prevented it fundamentally, hurt U.S. investors that weren't able to buy into a Bitcoin ETF with Bitcoin at $100 to $300, right? When I think about BNB today, by it not being easily accessible in the U.S. investors have been hurt by not being able to access and be part of this thriving BNB ecosystem that's kind of grown to where it is. And, and so I'm really trying to help get people, open up people's eyes to it and get them that access, for the medium and long term. Now, in terms of the dynamics, well, look, as we've gone through a lot of the history here, there's periods of exuberance, there's periods of pessimism and panic. We just had last week one of the biggest sell-offs, or I think the biggest sell-off ever in crypto history. And, in a number of ways, the markets bounced back very strong and people are feeling very confident. BNB actually managed to outperform and ended up breaking to new highs even after the sell-off and, showing a lot of resilience. And I think with crypto, it's important to realize the volatility has always been an important feature of it, right? And when you have an asset that's growing significantly, volatility is a good thing. And so it's important to zoom out and think about where this is going. And if we think, if someone were to think that, well, this is the end for crypto assets and it's not going to become a bigger and bigger part of society and financialization of the world and, all that, then it's easy to panic and get worried about where we are. When you think and believe in the vision that this is going to be a much larger asset class over time, well, then thinking about these specific vehicles and thinking about all the treasury opportunities, it does become a little less relevant in the short term, whether it's trading at a premium or trading at a small discount. Now, the key thing is, right, the companies that are operating treasury strategies, when I think about, all right, what are the most important aspects? The most important aspects are to grow the net crypto asset per share, the Bitcoin, the BNB, or the Ethereum per share, right? And not to put those assets at risk. So that's a reason why I kind of bring up, and I'm very averse to taking on convertible debt or anything that's going to harm the balance sheet. Because there's also an aspect when you look at with Ethereum, with Solana, with BNB, there's a number of staking and yield and revenue generating opportunities. So even if the asset or the treasury equity gets valued at a discount over time, with the yield that's generated and the ability to buy back the shares when they're at a discount, that ends up also being accretive and kind of increasing the BNB per share for all of the other investors. In April, May of this year, I was at the Bitcoin conference in Vegas, and I think my single most important takeaway was Michael Saylor was getting grilled very hard on all of these things of what he's going to do when his premium goes away and if the stock ever trades at a discount to their NAV. And he calmly said, he's like, well, listen, let's just say if we have $50 billion of Bitcoin and there's $5 or $10 billion of people, of idiots that want to sell the stock at a 20, 30, 50% discount. Well, I'll issue preferred shares. I'll buy that back. Everybody else benefits and makes money from me buying those shares at a discount, right? So the key thing that I took away from that was part of running a successful treasury company is the ability to access capital in good markets and bad markets, and the ability to have that medium and long-term, opportunity to grow the value and allow this accretive process to play out.
Fantastic. David, thank you for such a broad conversation and really excited about what you're doing. If our audience wants to learn more about you and about the company, where should they go?
So I try to share everything on my Twitter at Namdar, on the companies at BNB Network Co., and on our website at bnc.network. That's a good starting point.
Awesome. Great to have you.
Thank you as well. It's been great.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.